The real question is, who are we selling this to?
Same people we've been selling it to for the last 2 years, and whoever else will buy it.
But John, if you do this, you will kill the market for years. It's over.
Today is kind of the first day in a long time where we've had any kind of contagion fears, like where something could grow into something much bigger. And what's really interesting is that U.S. Treasuries have been rallying over the last 48 hours on this news. And, for the last, let's call it year, Treasuries falling in price as yields rose in the face of inflation was the cause of the volatility, was the cause of equities selling off. So this is the first time in a while that we've seen, Treasuries rallying kind of on a safe haven bid. And it's just kind of interesting because, over the last year, as Treasuries have fallen so much, people have said Treasuries are no longer a safe haven bid. Today, when we get a little bit of risk off and a potential contagion, we got Treasuries rallying. So it's a very interesting time. It's a very interesting day. It certainly wasn't a boring day, and we'll see what happens with the next week.
Yeah. So one of the things that we also have talked about a lot off air is the kind of the reaction mechanism of both markets and just people who are engaged in the conversation around markets. Is they're bouncing all over the place. There's not a real grounded mentality about how they're approaching either their investments or at least investment conversations. There's a lot of ideology. People are very, very deeply rooted in their bias. And so you start to see these kind of, volatility spikes in these types of moments because no one's winning. And, you coined the phrase a couple episodes ago, violently sideways. And all this, though, if this feels like we're kind of turning a corner and maybe it's risk off and bonds are going to be a bid again. I mean, number one, when you have a move this big, this was the largest move in the 2-year since Lehman. So 2008, it's very unlikely that this trend continues on Monday. And not to say that this trend doesn't continue over the next couple of weeks, but when you have these big moves, there's usually some sort of rebalancing. But I feel like people's emotions don't rebalance with the market, and so we are kind of seeing this this continually play out over and over and every week when you have the volatility where no one can really say, "See, I told you so," except for maybe a day or two. One of the things that we've been pushing in the last couple episodes, and again we've talked about recently off air, is people need to kind of let go of their belief system and stop chasing things that are going to reinforce their bias.
Yeah, and what I think is kind of interesting is a lot of times people will say, yes, central bankers have influence and government officials have influence, but the markets are bigger than the governments and markets are bigger than regulators, and ultimately the markets are going to win. And first of all, I completely 100% agree with this. And a lot of times I will hear that with regard to gold. Okay, so gold's down now, but in the long term, gold is absolutely going to go higher, right? And so, over the last year, the Treasury has been raising rates. They've wanted asset prices lower. They've actually wanted bond prices lower. I don't care what you think about the Fed. They're not so stupid that they don't understand if you raise rates, the bond prices fall. That's what they're trying to do. They're trying to engineer a slowing economy. They want to engineer a slowing economy in order to fight inflation. One of the ways you engineer a slowing economy is you contract the collateral off of which new money can be created. And that means bond prices go lower. But yet today, bond prices went higher, a lot higher. So even though the regulators and the Fed wanted prices lower, they got bond prices higher today. So my point is this, markets winning doesn't just relate to the Fed. It doesn't just relate to the gold market. There's a lot of other assets that kind of have the same thing going. And, ultimately the markets are going to play out. And it's, to me, what's really interesting is over the last couple of years, every time we've had any kind of a risk off event, it hasn't lasted for very long. And it didn't cause any contagion. And even last year, as equity prices went down a lot, there was never like a big contagion. It never felt completely out of control. The Fed kept hiking rates regardless of markets going down. So what's really interesting to me now is to see whether this event, this Silicon Valley Bank event, will lead to any kind of contagion. Because for the last year or so, it hasn't. And I think, to your point, I think it's very easy to see the headline and say, yes, this is it. This means the banking system is going to collapse next week, right? Now, I'm going to say maybe it will. I can't say for sure that it won't, and I understand all the dynamics that could lead to that happening. But it wouldn't shock me at all to walk in on Monday morning and see, markets are up 1%. And that, maybe they do something over the weekend that changes the mood and everything's fine for another month or another 6 months or whatever it is. So it's just a long way of saying that, pay attention, understand the headlines that you're seeing, but don't necessarily jump from one headline to the other.